Hello and welcome. Whether you're a seasoned independent contractor or just starting your journey as a freelancer in the United States, designed to empower you with knowledge. Over the next 15 chapters, we'll be exploring a topic that is crucial to your financial success: tax deductions. Specifically, we'll be shining a light on the commonly overlooked tax deductions that can make a significant difference in your bottom line. Before we dive in, it is absolutely essential to start with a very important disclaimer. The information provided in this series is for educational and informational purposes only. It is not intended to be a substitute for professional tax, legal, or financial advice. The tax laws in the United States are complex and subject to change. Your individual financial situation is unique, and what might be applicable to one person may not be for another. Therefore, it is highly recommended that you consult with a qualified professional, such as a certified public accountant or a tax attorney, who can provide advice tailored to your specific circumstances. This series is not intended to create any kind of professional-client relationship. You acknowledge that the creator is not liable for any financial decisions you make based on this information. Our goal is to provide you with a broad understanding of the possibilities, so that you can have more informed conversations with your tax advisor. We will not be providing any specific financial or investment advice, nor will we be encouraging you to take any particular course of action. Think of this as a roadmap to help you navigate the terrain of freelancer taxes, with your professional advisor as your trusted guide. Now, with that crucial understanding in place, let's begin. The world of freelancing offers incredible freedom and flexibility. You are your own boss, you set your own hours, and you have the power to shape your career path. However, this autonomy also comes with a new set of responsibilities, and one of the most significant is managing your own taxes. Unlike traditional employees who have taxes withheld from each paycheck, freelancers are responsible for calculating and paying their own taxes to the Internal Revenue Service, or IRS. This includes income tax and self-employment tax, which covers your Social Security and Medicare contributions. At first glance, this can seem daunting. The idea of owing a substantial amount in taxes at the end of the year can be a source of stress for many freelancers. But here's the good news. As a business owner, which you are as a freelancer, you are entitled to deduct the ordinary and necessary expenses of running your business from your gross income. So what exactly is a tax deduction? In simple terms, a tax deduction is an expense that you can subtract from your total income, which in turn reduces the amount of income that you're taxed on. A lower taxable income means a lower tax bill. It's that straightforward. The more legitimate business expenses you can identify and claim, the less you'll owe the government. This is not about finding loopholes or evading taxes. It's about understanding and utilizing the tax laws as they are written for business owners. Think of it this way. Every dollar you spend on a legitimate business expense is a dollar that the IRS doesn't get to tax. This is a powerful tool for maximizing your earnings and reinvesting in your business. However, the key to unlocking the full potential of tax deductions lies in one fundamental practice: meticulous record keeping. Throughout this series, we will repeatedly emphasize the importance of keeping detailed and organized records of all your income and expenses. This is non-negotiable. In the event of an audit by the IRS, the burden of proof is on you to substantiate your claimed deductions. Without proper documentation, even the most legitimate expense can be disallowed. So what does good record keeping look like? It means saving all of your business-related receipts, either physically or digitally. It means maintaining a separate bank account and credit card for your business transactions to avoid commingling personal and business finances. It means using accounting software or a simple spreadsheet to track your income and categorize your expenses as they occur, not scrambling to remember everything at the end of the year. This habit of diligent record keeping will not only prepare you for tax time, but will also give you a clearer picture of your business's financial health throughout the year. It will help you identify areas where you might be overspending and make more informed financial decisions for your business's growth. Now, you might be wondering what kinds of expenses qualify as tax deductible. The IRS defines a business expense as being both ordinary and necessary. An ordinary expense is one that is common and accepted in your trade or business. A necessary expense is one that is helpful and appropriate for your trade or business. An expense does not have to be indispensable to be considered necessary. In the upcoming chapters, we will delve into a wide array of specific deductions, many of which are often overlooked by freelancers. We will explore topics such as the home office deduction, which allows you to deduct a portion of your rent or mortgage, utilities, and other home-related expenses if you use a part of your home exclusively and regularly for your business. We'll discuss how to properly deduct vehicle expenses when you use your car for business-related travel. We'll cover the costs of business-related software, subscriptions, and professional development courses that can help you stay competitive in your field. We will also touch upon deductions for health insurance premiums, contributions to retirement plans, and even the costs of your internet and phone bills. The goal is to provide you with a comprehensive overview of the potential deductions available to you, so you can be prepared to discuss them with your tax professional. It's important to remember that being a freelancer means you are running a business. Adopting a business owner's mindset is crucial for your success. This includes taking a proactive approach to your finances and your taxes. By educating yourself about tax deductions, you are not just saving money, you are investing in the long-term viability and profitability of your freelance career. This first chapter has laid the groundwork. We've established the critical importance of seeking professional advice, the fundamental concept of tax deductions, and the non-negotiable necessity of meticulous record-keeping. As we move forward, we will build upon this foundation, exploring specific categories of deductions in detail. So get ready to empower yourself with knowledge. Get ready to take control of your freelance finances. In our next chapter, we will begin our deep dive into the world of commonly overlooked tax deductions by focusing on one of the most significant and often misunderstood, the home office deduction. We'll break down the requirements, explore the different methods for calculating it, and help you understand how to claim this valuable deduction with confidence. Thank you for joining me for this introductory chapter. I look forward to continuing this journey with you. Welcome back. In our first chapter, we laid the essential groundwork for understanding freelancer tax deductions. We emphasized the importance of a business owner's mindset, the critical role of record-keeping, and the absolute necessity of consulting with a qualified tax professional. Today, we're going to build on that foundation by diving deep into one of the most valuable, and yet most frequently misunderstood, deductions available to U.S. freelancers: the home office deduction. For many independent contractors, your home isn't just where you live. It's your headquarters, your studio, your primary place of business. The IRS recognizes this, and the tax code allows you to deduct a portion of your household expenses against your business income. This can translate into significant savings, but it's a deduction that often causes confusion and even fear. Many freelancers worry about it being a red flag for an audit. While it's true that you must follow the rules carefully, you should not be afraid to claim a deduction you are legally entitled to. The key is to understand the requirements and maintain impeccable records. Again, please remember the vital disclaimer from our first chapter. This information is for educational purposes only and does not constitute professional tax or legal advice. You must consult with a qualified professional to understand how these rules apply to your specific situation. So, what does it take to qualify for the home office deduction? The IRS has two fundamental tests that you must meet. These are the exclusive use test and the regular use test. Let's break down what each of these means. First, the exclusive use test. This is the stricter of the two requirements and the one that often trips people up. To meet this test, you must use a specific area of your home only for your trade or business. There can be no personal use of that space. For example, if you have a spare bedroom that you have converted into an office with your desk, computer, and filing cabinets, and you use that room solely for your work, you meet the exclusive use test for that space. However, if that same room also contains a guest bed that your family uses when they visit, or a television where you relax in the evenings, it fails the exclusive use test. The area you claim does not have to be a full room separated by a permanent wall. It can be a clearly defined section of a larger room. You could, for instance, claim the corner of your studio apartment where your design desk and equipment are set up, as long as that corner is used exclusively for your business activities. The kitchen table, where you also eat your meals, will almost never qualify. The key is that the business portion of the home is a separately identifiable space dedicated solely to your work. Second, we have the regular use test. This test is a bit more subjective. You must use the designated business space in your home on a continuing and ongoing basis. Occasional or incidental business use is not enough. For example, using your home office once a month to catch up on paperwork likely wouldn't be considered regular use. However, if you work from that space several times a week, every week, you would almost certainly meet the regular use test. The IRS doesn't provide a specific number of hours you must work, but the use must be a consistent part of your business operations. In addition to these two tests, your home office must also be your principal place of business. For most freelancers working from home, this is easy to prove. It's the primary location where you generate your income. It can also qualify if it's the place where you conduct the essential administrative or management activities for your business, such as billing, bookkeeping, and scheduling, provided you don't have another fixed location where you conduct those same activities. For instance, a plumber who spends most of their day at client sites can still claim a home office deduction if they use a space at home exclusively and regularly to manage their appointments, send invoices, and order supplies. Once you've determined that you meet these qualifications, the next step is to calculate the amount of your deduction. The IRS provides two different methods for doing this: the simplified method and the regular method. Let's explore both, as the best choice can vary from person to person. First, the simplified method. As its name suggests, this is the more straightforward of the two options. It requires less record keeping and is very easy to calculate. With this method, you deduct a standard rate of $5 per square foot of your home used for business. However, there is a cap. You can only use this method for up to a maximum of 300 square feet. This means the largest possible deduction you can take using the simplified method is $1,500 per year. To calculate it, you simply measure the square footage of your exclusive business space and multiply it by $5. If your office is 150 square feet, your deduction is $750. If it's 350 square feet, your deduction is capped at $1,500 because you've exceeded the 300 square foot limit. This method is a great option for those who want to avoid complex calculations and extensive record keeping of individual home expenses. Now let's look at the second option, the regular method. This method requires more work, but it often results in a significantly larger deduction, especially for those with larger office spaces or higher housing costs. With the regular method, you calculate the percentage of your home that is used for business. You can do this by dividing the square footage of your office by the total square footage of your home. For example, if your office is 200 square feet and your entire home is 2,000 square feet, your business use percentage is 10%. Once you have this percentage, you can deduct that portion of your indirect household expenses. Indirect expenses are costs that benefit your entire home, such as rent, mortgage interest, property taxes, homeowner's insurance, utilities like electricity and gas, and general home repairs. So in our 10% example, if you paid $12,000 in rent for the year, you could deduct $1,200. If your utility bills for the year totaled $2,400, you could deduct $240. In addition to these indirect expenses, the regular method allows you to deduct 100% of any direct expenses. Direct expenses are costs that apply only to your home office space. This could include painting the office, repairing a window in the office, or installing dedicated shelving for your business materials. The regular method also allows you to claim depreciation on the portion of your home used for business if you are a homeowner. This is a more complex calculation that accounts for the wear and tear on your property over time, and it's an area where consulting with a tax professional is especially important. So which method should you choose? It's a personal calculation. The simplified method is easy but might leave money on the table. The regular method can yield a larger deduction, but requires you to have kept meticulous records of all your housing expenses throughout the year. It's a good practice to calculate your deduction using both methods each year to see which one is more beneficial for you. Your tax software or tax advisor can help you with this comparison. Regardless of the method you choose, remember that record keeping is your best friend. For the home office deduction, this means you should have photos of your dedicated workspace. You should have a floor plan of your home with the office dimensions clearly marked. If you use the regular method, you must keep every single receipt and bill for your rent, utilities, insurance, and repairs. A dedicated folder, physical or digital, for these documents is an absolute must. Having this documentation ready will give you peace of mind and the confidence to claim the deduction you rightfully deserve. In our next chapter, we'll shift our focus from your home to your vehicle. We'll explore the often overlooked tax deductions associated with using your personal car for business purposes, another area where freelancers can find substantial savings. Thank you for listening. Hello and welcome back. In our previous chapter, we transformed your living space into a potential source of significant tax savings by exploring the home office deduction. Today, we're moving out of the office and into your car. For a vast number of freelancers, a personal vehicle is an essential business tool. You might be a photographer driving to a photo shoot, a consultant meeting with a client, a craftsperson visiting a supplier, or a rideshare driver navigating the city. If you use your car, truck, or van for business, The costs of operating that vehicle can be another powerful source of tax deductions. As always, we must begin with our important reminder. This chapter is for informational and educational purposes only. It is not tax, legal, or financial advice. The rules surrounding vehicle deductions can be intricate, and you should always consult with a qualified tax professional who can analyze your personal situation and provide guidance accordingly. This information is intended to help you prepare for that conversation. The first and most critical concept to understand when it comes to vehicle deductions is the distinction the IRS makes between business mileage and commuting mileage. This distinction is the foundation of the entire deduction. Business mileage is generally defined as travel between two different business locations. This includes travel from your primary place of business, which, as we learned in the last chapter, can be your home office, to meet with a client, go to a second work site, or run business-related errands like picking up supplies, or going to the post office to mail client packages. These are the miles you can deduct. Commuting mileage, on the other hand, is the travel between your home and a regular or main place of work. For most people, this is the daily drive to and from an office. The IRS considers commuting a personal expense and therefore, it is not deductible. This can be a gray area for freelancers. If you have a qualifying home office that serves as your principal place of business, then driving from your home to your first business stop of the day, such as a client's office, is considered deductible business mileage. However, if you do not have a principal place of business at home, and you travel to a permanent office or work site elsewhere, that travel is generally considered non-deductible commuting. Understanding this difference is key to accurately tracking your deductible miles. Now that we know what kind of mileage counts, let's look at how you calculate the deduction. Just like with the home office, the IRS provides two primary methods: the standard mileage rate and the actual expense method. First, let's discuss the standard mileage rate. This is the simpler of the two methods. The IRS sets a specific rate per mile for business use each year. For the 2024 tax year, that rate is 67 cents per mile. This rate is designed to cover all the variable costs of operating your vehicle, such as gasoline, oil, maintenance, and repairs, as well as the fixed costs of depreciation and insurance. To calculate your deduction using this method, you simply multiply your total number of business miles for the year by the standard rate. For example, if you drove 5,000 documented business miles in 2024, your deduction would be 5,000 miles times 67 cents, which equals $3,350. It's that straightforward. One of the great things about the standard mileage method is that, in addition to the per mile rate, you can also separately deduct business-related parking fees and tolls. So, if you paid for parking for a client meeting or crossed a toll bridge on your way to a project site, you can add those costs on top of your standard mileage deduction. The main advantage here is the simplicity and the reduced need for detailed expense record keeping, though, as we'll discuss, you still need to keep a detailed mileage log. The second option is the actual expense method. This method is more complex and requires you to track every single cost associated with operating your vehicle for the year. It can, however, result in a larger deduction, particularly if you have a newer, more expensive vehicle or if your operating costs are high. Under the actual expense method, you first need to determine your business use percentage for the vehicle. You do this by dividing your total business miles for the year by the total miles you drove all year, for both business and personal use. For instance, if you drove 20,000 total miles and 8,000 of those were for business, your business use percentage is 40%. 8,000 divided by 20,000. Once you have that percentage, you can deduct that portion of all your vehicle expenses. These expenses can include gasoline and oil, maintenance and repairs, tires, insurance, registration fees, license fees, and lease payments if you lease your vehicle. You can also deduct depreciation on the vehicle if you own it, which allows you to recover the cost of the vehicle over time. Depreciation is a complex calculation with its own set of rules and limits, making it another area where professional advice is invaluable. So, using our 40% example, if your total vehicle expenses for the year, gas, insurance, repairs, etc., amounted to $10,000, your deduction would be $4,000. Just like with the standard method, you can still deduct 100% of any business-specific parking fees and tolls on top of this amount. There's an important rule to be aware of when choosing between these two methods. If you want to have the flexibility to switch between methods in future years, you generally must use the standard mileage rate in the first year you use the car for your business. If you choose the actual expense method in the first year, you may be required to stick with that method for as long as you use that vehicle for your business. This is a strategic decision that is best discussed with your tax advisor. Now we come to the single most important part of this entire chapter: record keeping. The IRS is extremely strict about the documentation required to claim vehicle expenses. If you are ever audited, you will be asked to produce your records, and without them, your deduction will be disallowed. You cannot estimate your mileage at the end of the year. The IRS requires what it calls a contemporaneous record, meaning you must log your mileage at or near the time of the trip. Your mileage log, whether it's a physical notebook you keep in your car or a modern smartphone app, must contain specific information for every business trip. This includes the date of the trip, your starting point, your destination, the specific business purpose of the trip. Simply writing business is not enough. You need to be more descriptive, like client meeting with XYZ Corp, or purchase printing supplies at Office Depot. The starting and ending odometer readings for your vehicle for the trip, or at the very least, the total mileage for that trip. You also need to record your vehicle's starting odometer reading at the beginning of the year, and the ending reading on the last day of the year. This helps establish the total miles driven, which is necessary for calculating your business use percentage if you use the actual expense method. If you use the actual expense method, you must also keep receipts for every single expense you claim. Every gas fill-up, every oil change, every insurance payment. This might sound like a lot of work, but technology makes it easier than ever. There are numerous smartphone apps that use GPS to track your drives automatically and allow you to classify them as business or personal with a simple swipe. These apps can generate detailed, IRS-compliant reports that make tax time much less stressful. Investing in one of these tools is a very wise business decision. Deducting your vehicle expenses is a fantastic way to lower your tax bill, but it must be done correctly. Understand the difference between business and commuting miles. Choose the calculation method that works best for your situation after consulting a professional, and most importantly, commit to keeping a detailed, accurate, and contemporaneous mileage log. Hello and welcome to the 4th chapter in our series. In our last 2 discussions, we focused on 2 of the largest potential deductions for freelancers: your home and your vehicle. Today, we're zooming in on the day-to-day expenses that keep your freelance business running. These are the tools of your trade, the supplies, software, and equipment that are absolutely essential for you to do your work and serve your clients. While a single receipt for pens or printer paper might seem small, the cumulative total of these expenses over a year can be substantial, and every dollar is a potential deduction. Before we proceed, allow me to reiterate our foundational disclaimer. The information provided here is for educational purposes only and should not be considered professional tax, legal, or financial advice. Tax laws are complex, and your situation is unique. It is crucial to consult with a qualified tax professional to ensure you are complying with all IRS rules and maximizing your deductions in a legitimate way. This series is designed to arm you with knowledge for a more productive conversation with your advisor. Let's start with the most straightforward category: office supplies. These are the consumable items you use in your daily business operations. The IRS allows you to deduct the cost of supplies that are ordinary and necessary for your work. This can include a wide range of items such as paper, pens, ink and toner cartridges, staples, paper clips, notebooks, planners, postage and shipping supplies, and cleaning supplies for your dedicated office space. The key here is that these items are generally used up within a year. Think of them as the fuel for your business operations. If you're a graphic designer, this could also include specific items like sketch pads and drawing pencils. If you're a writer, it might include reference books or style guides. The rule is simple: if you bought it for your business and it's a necessary part of your work, keep the receipt. A common mistake freelancers make is paying for these small items with cash and forgetting to ask for a receipt, or mixing them in with personal grocery runs. It is vital to purchase business supplies separately and keep meticulous records. Every small deduction adds up. Next, let's talk about a category that is increasingly significant in the modern freelance economy: software and subscriptions. In today's digital world, very few freelancers can operate without specialized software. These costs are fully deductible business expenses. This includes both software you purchase outright and, more commonly, the recurring monthly or annual subscription fees you pay. Consider the tools you use every day. Are you a photographer paying for an Adobe Creative Cloud subscription? That's a deduction. Are you a project manager who relies on a tool like Asana or Trello? The subscription fee is deductible. A consultant who uses a customer relationship management or CRM platform? Deductible. Other common examples include accounting software like QuickBooks or FreshBooks, cloud storage services like Dropbox or Google Workspace, password managers, antivirus software, email marketing services, and subscriptions to industry-specific publications or research sites that help you stay current in your field. Again, the critical factor is that the software or subscription is for business use. If you have a subscription that you use for both personal and business purposes, you generally must allocate the cost and can only deduct the business use percentage. For example, if you estimate that you use your cell phone for business 60% of the time and personal use 40% of the time, you can typically deduct 60% of your monthly bill. Honesty and reasonable allocation are paramount. Keep invoices and statements for all these digital services, as they are just as important as physical receipts. Now let's move on to a slightly more complex area. Larger purchases like computers, furniture, and equipment. Unlike office supplies that are used up quickly, these are assets that you will use in your business for more than 1 year. This could be your laptop, a printer, a camera, a desk, an office chair, or specialized machinery related to your trade. The IRS views these long-term items differently than consumable supplies. You can't always deduct the full cost in the year you buy them. Instead, you often have to do what's called depreciation. Let's break down this concept. Expensing an item means you deduct its full cost in the tax year you purchased it. Depreciating an item means you spread that deduction out over the course of the asset's useful life, as defined by the IRS. For example, a computer generally has a useful life of 5 years according to IRS schedules. So, if you bought a $2,000 computer, instead of a single $2,000 deduction, you might take a $400 deduction each year for 5 years. The logic is that since the asset provides value to your business over several years, the deduction should also be spread out over those years. This is a foundational accounting principle. However, dealing with depreciation schedules can be complicated. Fortunately, for small business owners and freelancers, the tax code has provisions that can simplify this. One of the most useful is a rule known as the de minimis safe harbor election. This sounds complex, but the idea is simple. For relatively small purchases, the IRS allows you to elect to treat them like consumable supplies and deduct the full cost in the year you buy them, rather than depreciating them. As of the time of this recording, for freelancers who do not have what the IRS calls an applicable financial statement, which is most of us, you can often elect to use this safe harbor for any single item or invoice that costs $2,500 or less. So if you buy a new business laptop for $1,800, you may be able to elect to deduct the full $1,800 in the year of purchase instead of depreciating it over 5 years. This can provide a more immediate and impactful tax benefit. This is an annual election you make on your tax return, and it's another topic to specifically discuss with your tax advisor to ensure you qualify, and that it's the right strategy for you. There is also another provision, known as the Section 179 deduction, which may allow you to deduct the full purchase price of qualifying equipment and software in the year it is placed in service, but it has its own set of rules and limits. The main takeaway here is that you have options. You are not necessarily locked into complex depreciation schedules for every piece of equipment you buy. The golden rule, as always, is record keeping. For any piece of equipment, you must keep the receipt or invoice showing the date of purchase and the amount. It's also a good practice to take a photo of the item in your workspace and keep a simple asset list with the date you started using it for your business. From the pen on your desk to the computer you're working on, the tools of your trade represent a significant investment in your business. By carefully tracking these expenses, you can ensure that your investment pays you back, not just in productivity, but also in valuable tax savings. In our next chapter, we will shift our focus to costs related to professional growth and networking, including deductions for education, professional fees, and business-related travel. Thank you for listening. Hello, and welcome back to our series on commonly overlooked tax deductions for U.S. freelancers. So far, we've covered the spaces where you work and the tools you use. In this chapter, we're shifting our focus to a critical and often underutilized category of deductions: the expenses you incur to grow your skills, expand your network, and conduct business beyond your local area. These are the costs of investing in your most important business asset, yourself. As we dive into these topics, it is essential to remember our guiding principle is designed for educational purposes only. It is not a substitute for professional tax advice from a qualified expert like a CPA or tax attorney, who can provide guidance based on the specific details of your freelance business. The rules we're about to discuss have nuances, and professional consultation is the only way to ensure you are applying them correctly. Let's begin with continuing education and professional development. In a rapidly changing economy, staying current in your field isn't just a good idea, it's a business necessity. The IRS recognizes this and allows you to deduct the costs of qualifying work-related education. However, the key word here is qualifying. To be deductible, the education must meet one of two tests. Either it maintains or improves the skills you need in your current profession, or it is required by law or regulations to keep your license or professional status. For example, if you are a web developer and you take an online course to learn a new programming language, that cost is deductible because it directly improves your skills in your existing field. Similarly, if you're a real estate agent who is required to take continuing education courses to maintain your license, the tuition for those courses is deductible. This can also include the cost of seminars, workshops, webinars, and subscriptions to industry trade publications. You can also deduct related costs like books and necessary supplies for the course. However, there's a crucial distinction to make. The cost of education that is needed to meet the minimum requirements of your profession, or education that qualifies you for a new trade or business, is not deductible. For example, the cost of law school to become a lawyer is not deductible as a business expense, because it qualifies you for a new profession. Similarly, if you were a freelance writer and decided to go to school to become a certified financial planner, those tuition costs would not be deductible as a business expense against your writing income. The education must be related to the business you are already in. Next, let's discuss professional fees, dues, and memberships. Running a business often involves paying for services and memberships that support your operations. Many of these costs are deductible. A common one is dues paid to professional organizations. If you are a member of a trade association for graphic designers or a professional society for engineers, those membership fees are generally 100% deductible, as long as the organization is not primarily a social club. This category also includes other essential business costs. Bank fees on your dedicated business checking account are deductible. The fees you pay to payment processors like Stripe or PayPal on your client income are also deductible. This is a big one that many freelancers forget to track. Additionally, the money you pay for professional services is deductible. This includes the fees you pay to an accountant to prepare your business taxes, a lawyer to draft your client contracts, or a consultant to help you with your business strategy. These are all ordinary and necessary costs of doing business. Now let's broaden our horizons and talk about business travel. Sometimes, your work requires you to be somewhere other than home. You might travel to a different city for a client project, attend an industry conference, or go on a research trip. The IRS allows you to deduct the costs of business travel as long as the trip is ordinary, necessary, and takes you away from home for a period substantially longer than a regular workday, which typically means it requires you to rest or sleep overnight. Deductible travel expenses can include the cost of transportation, such as airfare, train tickets, or the cost of driving your own car, which we covered in Chapter 3. It also includes the full cost of your lodging, such as your hotel or Airbnb. Other deductible costs while traveling for business can include baggage fees, dry cleaning, and business-related phone calls. What about mixing business with pleasure? If your trip is primarily for business, but you extend your stay for a few days of vacation, you can still deduct the business-related portion of your expenses. For example, if you fly to a conference that runs from Monday to Wednesday, and you decide to stay until Friday for personal sightseeing, you can generally deduct the full cost of your round-trip airfare and your lodging and other expenses for the 3 business days. The costs for your 2 personal vacation days would not be deductible. This requires a clear and honest allocation of expenses. Finally, let's sit down and discuss one of the most common, yet confusing deductions: business meals. For years, the rules around deducting meals have been a source of debate, but the current guidelines are fairly clear. First, the big change from a few years ago is that expenses for entertainment are no longer deductible. This means you cannot deduct the cost of tickets to a sporting event, a concert, or a round of golf, even if you are with a client. However, the cost of business meals is still deductible, but typically only up to 50% of the total cost. For a meal to be deductible, it must have a clear business purpose. You must be present at the meal, and the cost cannot be lavish or extravagant under the circumstances. This includes meals with a current client, a prospective client, or a business associate where you are actively discussing business. It also includes meals you have by yourself while traveling away from home overnight for business. So, if you take a potential client to lunch to discuss a new project and the bill is $80, you can generally deduct $40. It is absolutely crucial to document these expenses properly, on the back of the receipt, or in a digital app, you should immediately note who you were with, their business relationship to you, and the specific business topic you discussed. Simply having a credit card statement from a restaurant is not enough to prove the business purpose of the meal in the event of an audit. There are a few exceptions where business meals can be 100% deductible, such as for a company-wide holiday party or a picnic for your team. But for most day-to-day freelance operations, the 50% rule will apply. Investing in your professional development and your business network is essential for growth. By keeping meticulous records of your educational pursuits, travel, and business meals, you can turn these investments into valuable tax deductions that help fuel your continued success. In our next chapter, we will discuss deductions related to protecting yourself and your business, including insurance and retirement savings. Hello and welcome back. In our journey so far, we've explored deductions that reduce your taxable income based on the costs of running your business day to day. Today, we turn our attention to a category of deductions that serves a dual purpose. They not only lower your tax bill now, but they also provide a crucial safety net for your health, your business, and your future. We're talking about deducting the costs of insurance and your contributions to retirement plans. These are, without a doubt, some of the most empowering financial tools available to freelancers. Before we delve into these important topics, we must once again state our essential disclaimer. The information in this chapter is for educational and informational purposes only. It is not, and should not be considered, professional tax, financial, or legal advice. Decisions about insurance and retirement are significant and have long-term consequences. It is imperative that you consult with qualified licensed professionals, such as a tax advisor, a financial planner, and an insurance agent, who can provide advice tailored to your specific financial situation and goals. Let's begin with a topic that is on every freelancer's mind: health insurance. When you leave a traditional job, you often leave behind employer-subsidized health coverage, and the cost of purchasing your own policy can be a shock. The good news is that the IRS allows self-employed individuals to deduct the premiums they pay for medical, dental, and qualifying long-term care insurance for themselves, their spouse, and their dependents. This is one of the most valuable deductions available. It's not a business expense you claim on your Schedule C, nor is it an itemized deduction. Instead, the self-employed health insurance deduction is what's known as an above-the-line deduction, which means you take it directly on the front of your Form 1040. This is powerful because it reduces your adjusted gross income, or AGI, which can help you qualify for other tax credits and deductions. However, there are two critical rules you must meet to be eligible. First, your freelance business must have a net profit for the year. Your deduction cannot exceed the profit your business earned. If your business breaks even or has a loss, you generally cannot take this deduction, although you may be able to include the premiums as an itemized medical expense on Schedule A, subject to its own limitations. Second, you or your spouse cannot be eligible to participate in an employer-subsidized health plan. For example, if your spouse has a traditional job and you are eligible to be covered under their company's family health plan, you cannot take the self-employed health insurance deduction, even if you choose not to enroll in that plan. This eligibility rule is strict, so it's important to understand it clearly. If you qualify, this deduction is a major benefit that directly reduces the financial burden of staying insured. Beyond your health, you also need to protect your business. This brings us to business insurance. The premiums you pay for various types of business insurance are generally fully deductible as ordinary and necessary business expenses on your Schedule C. These policies act as a shield, protecting you from financial loss in the event of unforeseen circumstances. Common types of deductible business insurance for freelancers include professional liability insurance, also known as errors and omissions or E&O insurance. This is crucial for consultants, designers, writers, and anyone providing professional services, as it protects you against claims of negligence or failure to perform your work as promised. Another is general liability insurance, which covers claims of bodily injury or property damage to a third party. For example, if a client visits your home office and trips and falls, this insurance could cover their medical costs. If you rent a commercial office space or studio, you may be able to deduct the cost of renter's insurance for the business portion of the policy. Protecting your business isn't just a smart move, it's a deductible one. Now let's talk about your future. As a freelancer, you are your own HR department, which means you are solely responsible for your retirement planning. This can seem intimidating, but it also presents an incredible opportunity to lower your current tax bill while saving for the long term. Contributions you make to a qualified self-employed retirement plan are tax deductible. Let's look at a couple of the most popular options. First is the SEP IRA, which stands for Simplified Employee Pension. The simplified part is key. A SEP IRA is very easy and inexpensive to set up and maintain. With this plan, you make contributions for yourself as the employer. For a given year, you can contribute up to 25% of your net adjusted self-employment income, not to exceed a specific dollar limit, which is adjusted annually for inflation. For 2025, that limit is a substantial $70,000. The contributions you make are deducted on your Form 1040, lowering your taxable income for the year, and the money grows tax-deferred until you withdraw it in retirement. Another excellent, though slightly more complex, option is the Solo 401k. This plan is only available to self-employed individuals with no employees, other than a spouse. The power of the Solo 401k is that it allows you to contribute in two different ways, as the employee and as the employer. As the employee, you can contribute up to 100% of your compensation up to the annual deferral limit, which is $23,500 for 2025. Then as the employer, you can contribute an additional amount, typically up to 25% of your net adjusted self-employment income. The total combined contributions cannot exceed the annual limit, which is also $70,000 for 2025. This dual contribution structure often allows you to save a larger amount of money at lower income levels compared to a SEP IRA. Additionally, Solo 401k plans may offer a Roth contribution option, where you contribute with after-tax dollars for tax-free growth and withdrawals, and they may also allow for plan loans, which SEP IRAs do not. Choosing the right retirement plan is a major financial decision. A SEP IRA offers simplicity, while a Solo 401k provides more flexibility and potentially higher contribution capacity. Other options, like a simple IRA, also exist. This is not a decision to be made lightly or based on general information alone. It is absolutely essential to speak with a financial advisor who can help you assess your goals, income, and savings capacity to determine the best path forward for you. Protecting yourself with health insurance, safeguarding your business with liability coverage, and systematically saving for your future in a tax-advantaged retirement plan are not expenses. They are investments. They are fundamental components of a sustainable and successful freelance career. In our next chapter, we'll address the taxes you pay directly as a freelancer, specifically the self-employment tax, and explore deductions that can help lessen that burden. Hello and welcome. In our journey through the landscape of freelancer tax deductions, we've focused on the various business expenses you can subtract from your income. In this chapter, we're going to tackle a specific tax that is unique to the self-employed, a topic that can often cause confusion and concern: the self-employment tax. But more importantly, we are going to discuss a powerful, built-in deduction that helps to lessen its impact. As we navigate this crucial subject, please remember our most important guideline. This content is for educational and informational purposes only, and is not a substitute for personalized advice from a qualified tax professional. The self-employment tax calculation is a core part of your tax return, and working with a professional is the best way to ensure accuracy and compliance. This chapter aims to demystify the topic, so you can be better prepared for those professional conversations. First, what is the self-employment tax? When you work for a traditional employer, you see FICA taxes taken out of your paycheck. FICA stands for the Federal Insurance Contributions Act, and it's a combination of two separate taxes: a 6.2% tax for Social Security, and a 1.45% tax for Medicare, for a total of 7.65%. Your employer then matches this amount, paying another 7.65% on your behalf. This brings the total contribution to Social Security and Medicare to 15.3% of your wages. When you're a freelancer, you are both the employee and the employer. Consequently, you are responsible for paying both halves of the FICA tax. This combined 15.3% tax is what's known as the self-employment tax. It is the price of funding your own Social Security and Medicare benefits for the future. You are required to pay this tax if your net earnings from self-employment are $400 or more in a year. This tax is calculated on Schedule SE of your Form 1040, and is in addition to your regular federal income tax. Seeing that 15.3% figure can be jarring for new freelancers, but here is where the tax code provides some essential relief. Because you are considered both the employer and the employee, the IRS allows you to deduct the employer portion of your self-employment tax. This is known as the deduction for 1/2 of your self-employment tax. Let's break down the logic. A traditional employer gets to deduct the 7.65% FICA contribution they make for their employees as a regular business expense. To create a level playing field, the IRS gives you, the self-employed individual, a similar benefit. You get to deduct 1/2 of what you pay in self-employment tax. This is a very important above-the-line deduction. Similar to the self-employed health insurance deduction we discussed earlier, you claim it directly on your Form 1040, and it reduces your adjusted gross income, or AGI. It does not reduce your net earnings from self-employment for the purpose of calculating the tax itself, but it does reduce the amount of income that is subject to your regular income tax. Here's a simplified example to illustrate the point. Let's say after all your calculations on Schedule SE, you determine that your total self-employment tax for the year is $10,000. When you go to calculate your income tax, you will be able to deduct half of that amount, which is $5,000, from your total income. If you are in the 22% income tax bracket, this $5,000 deduction would save you $1,100 on your income tax bill. It's a direct and significant benefit that is automatically calculated as part of your tax return. You don't need to do anything special to claim it, but it's crucial to understand why it exists and how it helps you. Now you might be asking, besides this built-in deduction, how can I lower the amount of self-employment tax I owe? The answer lies in everything we have discussed in the previous chapters. The self-employment tax is not calculated on your gross revenue. It's calculated on your net earnings from self-employment. Your net earnings are your gross income minus all of your ordinary and necessary business deductions. Every single dollar you claim for your home office, for your business mileage, for your office supplies, for your software subscriptions, for your health insurance premiums, and for your retirement contributions directly reduces your net income. A lower net income means a lower self-employment tax bill. This is why diligent record-keeping and claiming every legitimate deduction is not just about lowering your income tax. It is also your primary strategy for legally and ethically reducing your self-employment tax burden. Think of your business deductions as a powerful tool that works twice. First, to lower the income subject to income tax, and second, to lower the earnings subject to the 15.3% self-employment tax. Finally, it's important to understand how this tax is paid. Because you don't have an employer withholding it from a paycheck, you are responsible for paying your taxes throughout the year. This is done by making quarterly estimated tax payments. These payments should cover both your estimated federal income tax and your estimated self-employment tax. The due dates are typically April 15th, June 15th, September 15th, and January 15th of the following year. Failing to make these payments, or paying significantly less than you owe, can result in underpayment penalties from the IRS. Therefore, a good practice is to set aside a percentage of every payment you receive from clients. Many financial experts suggest 25 to 35%, depending on your income level and state tax rates, into a separate savings account specifically for taxes. This ensures the money is there when your quarterly payments are due. Your tax advisor or tax software can help you accurately calculate the amount you should be paying each quarter. The self-employment tax is a fundamental reality of being your own boss. But by understanding what it is, how the deduction for 1/2 of it works, and how all your other business deductions play a role in reducing it, you can approach this aspect of your finances with confidence and control. In our next chapter, we will delve into the often confusing world of business-related gifts, meals, and entertainment, clarifying what you can and cannot deduct in the current tax environment. Hello and welcome. A significant part of building a successful freelance career involves fostering strong relationships with your clients, partners, and professional network. This often involves gestures of goodwill like giving a gift or taking a contact out for a meal. The tax code acknowledges these activities as a part of doing business, but the rules surrounding them are very specific and have changed significantly in recent years. Today, we're going to clarify what you can and cannot deduct when it comes to business gifts, meals, and the now almost entirely non-deductible category of entertainment. As we navigate these nuanced rules, it is crucial to start with our standard, and very important, disclaimer. This chapter provides general educational information only, and does not constitute professional tax, legal, or financial advice. These specific areas are often scrutinized by the IRS, making it essential to keep impeccable records, and to consult with a qualified tax professional who can apply the law to your unique circumstances. Let's begin with business gifts. Giving a gift to a client can be a wonderful way to show appreciation or celebrate a milestone. The good news is that you can deduct the cost of business gifts. The not-so-good news is that the deduction is very limited. The IRS rule states that you can deduct no more than $25 per person per year. This $25 limit has been in place for a very long time, and is not adjusted for inflation. It applies to any gift you give directly or indirectly to an individual. So, if you send a client a holiday gift basket that costs $100, you can only deduct $25 of that cost. This limit is per recipient, not per gift. You cannot give 4 separate $25 gifts to the same person throughout the year and deduct them all. The total deduction for that one individual remains capped at $25 for the entire year. There are a few minor exceptions and clarifications to this rule. Incidental costs such as engraving, packaging, or shipping are not included in the $25 limit. So if you buy a $25 gift and pay an additional $10 for shipping, you can deduct the full $35. $25 for the gift and $10 for the shipping. Also, small promotional items that cost $4 or less, have your business name permanently on them, and are distributed widely like branded pens or keychains, are not subject to this limit. It's also important to note that you cannot deduct the cost of gifts of cash or cash equivalents, like a gift card. From a tax perspective, these are not considered gifts. Finally, and this is a critical point, if an item could be considered either a gift or entertainment, like tickets to a concert, the IRS will generally classify it as entertainment, which, as we will see, makes it non-deductible. Next, let's move on to the much more common expense of business meals. As we touched upon in a previous chapter, you can generally deduct 50% of the cost of a qualifying business meal. The temporary rule that allowed a 100% deduction for restaurant meals to support the industry has expired, so we are back to the standard 50% limit for most situations. For a meal to be deductible, it must meet several criteria. First, the expense must be ordinary and necessary in carrying on your business. Second, the meal cannot be lavish or extravagant under the circumstances. A reasonably priced lunch with a client is fine. An excessively opulent dinner might draw unwanted attention. Third, you or one of your employees must be present at the meal. You cannot simply pay for a client's meal and deduct it. Fourth, and most importantly, the meal must be with a business associate. This could be a current client, a prospective client, a professional advisor, or another business contact. And there must be a substantial business discussion before, during, or directly after the meal. You need to have a clear business purpose. The record keeping for business meals is a non-negotiable requirement. For every meal you claim, your records must show the total cost of the meal including tax and tip, the date and location of the meal, the name and business relationship of the person or people you dined with, a brief note on the business topics you discussed. You should get in the habit of writing this information directly on the receipt or logging it immediately in an accounting app. A credit card statement that just says City Steakhouse is not sufficient proof for the IRS. Finally, we arrive at the topic of entertainment expenses. This is an area where the law is now very clear and restrictive. Following the Tax Cuts and Jobs Act of 2017, the deduction for business-related entertainment is eliminated. You can no longer deduct the cost of entertaining clients, regardless of the business purpose. This means you cannot deduct expenses for activities such as tickets to a sporting event, tickets to a concert, play, or other performance, admission to a golf outing, fees for a hunting, fishing, or sailing trip, cover charges for a nightclub. This is a complete disallowance. Even if you spend the entire time at a baseball game discussing a major business deal with a client, the cost of the tickets is 0% deductible. However, there is a key distinction to be made between the entertainment itself and any food or beverages consumed during the entertainment. If you are at a sporting event and you buy food and drinks for yourself and a client, and the cost of that food and drink is stated separately on the invoice or receipt from the cost of the tickets, then the cost of the food and beverages can still be 50% deductible, provided it meets the other business meal requirements. The cost of the tickets remains non-deductible. Building strong business relationships is a vital investment. The tax code allows you to get a partial benefit for some of these costs, but only if you follow the rules with precision. Keep the $25 per person annual limit in mind for gifts. Remember the 50% rule and strict documentation requirements for meals, and understand that client entertainment is no longer a deductible business expense. In our next chapter, we will discuss some miscellaneous but often overlooked deductions that don't fit neatly into other categories, from bank fees to bad debts. Hello and welcome back. Throughout this series, we have covered many of the major categories of freelancer tax deductions, from your home office to your retirement plan. However, some of the most frequently overlooked deductions are the ones that don't fit neatly into a broad category. These are the miscellaneous, everyday costs of doing business that can add up to significant savings if you know what to look for. Today we're going to shine a light on these best of the rest deductions. As always, we must begin with our critical reminder. The information provided in this chapter is for general educational purposes only. It is not a substitute for professional tax advice tailored to your specific situation. These miscellaneous deductions can have their own unique rules, and a consultation with a qualified tax professional is the only way to ensure you are applying them correctly and legally. Let's start with an expense that every single freelancer with a dedicated business bank account will encounter: bank fees. While a monthly service fee of $10 or $15 might seem insignificant, it can amount to hundreds of dollars over the course of a year. The good news is that any fees associated with your business bank account are fully deductible. This includes monthly maintenance fees, transaction fees, wire transfer fees, and even those frustrating overdraft fees. This is one of the strongest arguments for maintaining a bank account that is used exclusively for your business. When your bank account is purely for business, you can deduct 100% of its associated fees without any question or need for allocation. Next, let's talk about the cost of borrowing money. Many freelancers use loans or credit cards to manage cash flow or finance business growth. The interest you pay on this borrowed money can be a deductible expense. This is the deduction for business loan and credit card interest. The rule is very straightforward. If you use a loan or a credit card exclusively for business purchases, the interest you pay on that debt is deductible. For example, if you take out a small business loan to purchase new computer equipment, the interest you pay on that loan is a business expense. Similarly, if you have a business credit card that you use only for things like software subscriptions, supplies, and business travel, the interest charges on your monthly statement are fully deductible. The key word once again is exclusively. You cannot deduct the interest on personal debts. This is why commingling business and personal expenses on a single credit card is strongly discouraged. It creates a record-keeping nightmare and makes it incredibly difficult to accurately calculate the deductible portion of your interest payments. Keep your business debt separate, and this deduction becomes simple and powerful. Another often missed deduction is the cost of getting professional help with your taxes. We're talking about tax preparation fees. The Tax Cuts and Jobs Act of 2017 eliminated the deduction for tax preparation fees as a miscellaneous itemized deduction for most individuals. However, for freelancers and other self-employed individuals, the story is different. You can deduct the portion of your tax preparation costs that are related to your business. This means you can deduct the fees you pay to an accountant or for tax software for the preparation of the business part of your return. For most freelancers, this means the part of the fee that is attributable to completing your Schedule C, profit or loss from business. If your tax preparer provides an itemized bill that breaks down the cost for your personal return versus your business forms, the calculation is easy. If not, you must make a reasonable allocation. For example, if your accountant says that roughly half of their time was spent on your business finances, you could deduct 50% of their total fee. The same logic applies to tax software. If you have to upgrade to a premium version of the software specifically to handle your freelance income and expenses, that upgrade cost would generally be deductible. Finally, we need to address a topic that is a source of great confusion and frustration for many freelancers: bad debts. What happens when a client simply refuses to pay you for work you've already completed? It's a painful situation, and the common assumption is that you should be able to write off that lost income as a bad debt. Unfortunately, for the vast majority of freelancers, this is not the case. The reason has to do with your accounting method. Most freelancers use what's called the cash method of accounting. This means you only record income when you actually receive the money. Since you never received the payment from the non-paying client, you never recorded it as income on your books in the first place. From the IRS's perspective, you can't take a deduction for income that you never had. You haven't suffered a direct economic loss on your tax return because that income was never counted. A bad debt deduction for unpaid services is only available to businesses that use the accrual method of accounting, where income is recorded when it is earned, not when it is received. Under this method, you would have already reported the invoice amount as income, even before you were paid. If the client then fails to pay, you are allowed to take a bad debt deduction to reverse the income you previously reported. Since most service-based freelancers find the cash method far simpler, the bad debt deduction is rarely available for unpaid invoices. While this is frustrating from a business perspective, it's a critical rule to understand to avoid making an improper claim on your tax return.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
These miscellaneous deductions, bank fees, business interest, tax preparation costs, and the rules around bad debts are all small but important pieces of your overall financial picture. By paying attention to these details, you ensure that you are not leaving any money on the table. In our next chapter, we will explore deductions related to your online presence, including the costs of building and maintaining your business website and other marketing efforts. Hello and welcome. In today's economy, a freelancer's success is often directly tied to their online presence. Your website is your digital storefront, your social media is your megaphone, and your online portfolio is your resume. Building and maintaining this digital footprint is not just a good idea. It is an essential business activity. As such, the costs associated with creating and promoting your online brand are considered ordinary and necessary business expenses, making them a rich source of tax deductions. As we explore this modern frontier of business expenses, we must anchor ourselves with our foundational disclaimer. This chapter is for educational purposes only and does not constitute professional tax, legal, or financial advice. The digital landscape and the tax rules surrounding it can be complex. Please consult with a qualified tax professional to ensure you are correctly applying these principles to your freelance business. Let's begin with the cornerstone of your online presence, your business website. For most freelancers, a website is non-negotiable. It's where you showcase your work, describe your services, and provide a way for potential clients to contact you. The ongoing costs of keeping this digital asset live and functional are generally fully deductible in the year you pay them. This category of deductible website expenses includes domain name registration, the annual fee you pay to own your .com or other web address, web hosting, the monthly or annual fees you pay to a company to keep your website's files on their servers and accessible to the world, website platform subscriptions, fees for services like Squarespace, Wix, or Shopify that provide the tools to build and manage your site, themes and plugins, the costs of purchasing premium themes to improve your site's design or plugins to add functionality, such as contact forms or e-commerce capabilities, stock photos and graphics, fees paid for licensed images, icons, or fonts that you use on your website. Routine maintenance. The cost of hiring a developer for minor updates, security checks, or bug fixes. These are all considered operating expenses, similar to the electricity that powers your office. Now, it's important to understand a slight distinction. If you undertake a massive one-time project to build a highly complex and custom website from the ground up, the IRS might view that large, upfront development cost as a capital expenditure. In simple terms, this means that instead of deducting the full cost at once, it would be treated as an asset that you would need to amortize or deduct incrementally over several years. However, for the vast majority of freelancers who use subscription services or have more modest websites, the ongoing operational costs are what you'll be deducting year after year. As always, for large projects, professional tax advice is key. Once you have a website, you need to get people to visit it. This brings us to the broad and powerful category of online advertising and marketing. Virtually any money you spend to promote your business online is a deductible expense. This is one of the most straightforward areas of tax deductions, and it covers a wide array of activities. Deductible online advertising costs include social media ads, the money you spend on promoted posts or ad campaigns on platforms like Facebook, Instagram, LinkedIn, and others. Search engine marketing, SEM, the cost of pay-per-click advertising, such as Google Ads, where you pay to have your website appear in search results for specific keywords. Email marketing services, the monthly or annual subscription fees for platforms like MailChimp or ConvertKit that allow you to build an email list and communicate with current and potential clients. Search engine optimization, SEO fees paid to a consultant or agency to help improve your website's ranking in organic search results. Content marketing, the costs associated with creating and promoting content to attract an audience, such as hiring a freelance writer for your blog or a video editor for your YouTube channel. Online directory listings, fees to be listed in professional directories or on freelance platforms. Think of it this way. If you are spending money to make your business more visible online and attract new clients, it is almost certainly a deductible advertising expense. The key, as always, is meticulous record keeping. Keep every invoice and digital receipt from these platforms. A clear and organized record of your marketing spend will make tax time simple and worry-free. Finally, let's talk about creating your professional portfolio. Your portfolio is your single most important marketing tool. While there isn't a specific deduction called the portfolio deduction, the costs of creating and showcasing your work are deductible under other categories we've discussed. It's helpful to break down the components. If you are a photographer, graphic designer, or artist, the materials you use to create the pieces for your portfolio are deductible as supplies. If you're a writer, the software you use is a deductible software expense. The costs of presenting that portfolio are also deductible. For example, hiring a professional photographer to take high-quality pictures of your physical work, or to take your professional headshot is a deductible business expense. The cost of printing a physical portfolio to take to client meetings falls under supplies or printing costs. The web hosting and domain fees for your online portfolio website are deductible as website costs. Your digital footprint is a dynamic and essential part of your freelance business. The investments you make in your website, in your online marketing, and in your professional portfolio are not just costs. They are legitimate, tax-deductible expenses that fuel the growth of your enterprise. In our next chapter, we will discuss the importance of proper tax planning and the benefits of hiring professional help, such as accountants and bookkeepers. Hello and welcome back. Over the past 10 chapters, we've armed you with a significant amount of knowledge about specific tax deductions you can claim as a U.S. freelancer. However, knowledge alone is only half the battle. The other half is implementation, organization, and strategic planning. Many freelancers, especially when starting out, try to manage every aspect of their business themselves, including the complex world of bookkeeping and taxes. In this chapter, we'll discuss why treating your financial management as a professional task, and even hiring help, is not a luxury but one of the smartest investments you can make in your business. As we discuss the roles of financial professionals, it's vital that we begin with our usual disclaimer. The information in this chapter is for educational purposes only. It is not intended to be a substitute for professional tax, financial, or legal advice that is tailored to your unique circumstances. Our goal is to explain the value of professional services, not to act as a replacement for them. The true value of professional help. As a freelancer, your most valuable asset is your time. Every hour you spend trying to decipher confusing tax forms or wrestling with a messy spreadsheet is an hour you are not spending on billable client work or on marketing to grow your business. This is where a change in mindset is crucial. Hiring a bookkeeper or an accountant is not just an expense. It is an investment in efficiency and peace of mind. A bookkeeper helps with the day-to-day financial record keeping. They ensure that all of your income is properly recorded and that every single business expense is categorized correctly. They maintain clean, accurate financial records, which are the foundation of a healthy business. An accountant or a certified public accountant (CPA) often takes a higher-level view. They can analyze the financial data your bookkeeper has organized, provide strategic advice, help you plan for the future, and of course, prepare and file your tax returns. For a freelancer, having a professional in your corner means you can focus on what you do best, serving your clients, secure in the knowledge that your finances are being handled correctly and strategically. An expense that pays for itself, deducting professional fees. Here is a simple and powerful fact that many freelancers overlook. The fees you pay for professional services for your business are a tax-deductible business expense. That's right. The cost of hiring an accountant to prepare your Schedule C, the monthly fee for a bookkeeper, or the price of the tax software you use are all deductible. Thinking about it this way reframes the entire decision. If you are in a 22% tax bracket, a $500 fee to a tax preparer effectively only costs you $390 out of pocket, because you will save $110 on your tax bill from that deduction. A good accountant will almost always save you more in taxes than the cost of their fee, either by finding deductions you missed or by helping you avoid costly mistakes and penalties. Beyond tax prep, the power of proactive tax planning. One of the biggest mistakes a freelancer can make is to think about taxes only once a year, in the frantic weeks leading up to the April deadline. True financial control comes from proactive tax planning, which is a year-round activity. This is where a good accountant provides immense value beyond just filling out forms. A tax professional can help you structure your business. They can advise if operating as a sole proprietor is still the best option, or if it might be time to consider forming an LLC or an S-corporation for tax or liability reasons. Time your purchases. They might advise you to purchase needed equipment before the end of the year to accelerate a deduction and lower your current year's tax bill. Maximize retirement contributions. They can help you understand the deadlines and limits for contributions to your SEP IRA or solo 401k, ensuring you get the maximum possible deduction. Stay informed. tax laws change. A professional's job is to stay on top of these changes and advise you on how they might impact your business. This kind of strategic partnership transforms your relationship with taxes from a reactive, stressful event into a proactive, empowering part of your business strategy. Mastering your estimated quarterly taxes. Perhaps the single most important financial habit a freelancer must develop is paying estimated quarterly taxes. As we discussed in a previous chapter, you are responsible for paying your income and self-employment taxes throughout the year. The IRS sets 4 due dates for these payments. Calculating the correct amount to pay each quarter can be challenging, especially if your income fluctuates. If you pay too little, you'll face an underpayment penalty. If you pay too much, you're giving the government an interest-free loan with your money. This is an area where a tax professional is indispensable. They can analyze your income and expenses and use specific IRS-approved methods to accurately project your tax liability for the year. They will tell you how much to pay and when to pay it. This service alone removes a massive source of stress and uncertainty from the freelance experience, ensuring you stay compliant and penalty-free. Hiring professional help is a sign of a mature and serious business owner. It's a declaration that you value your time and are committed to building a financially sound and successful freelance career.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.